Joining us now is Bespoke Investment Group co-founder Paul Hickey. Paul, love your read on things here in terms of, at least in the short term, how the market has digested what it heard from the Fed. We've had this revisitation of the June lows, and now the question is, what's different and what's the same about what we saw in June about how the market is positioned?
Yeah, so I think there's a lot of concern. We're heading into an earnings season coming up here, similar to how it's a very similar setup. We're heading into an earnings season where expectations are low in June, and we're heading into an earnings season now where expectations are low. From a seasonal perspective, we don't like to put all of our weight on seasonality, and you would never invest based solely on seasonality, but we're in an interesting dichotomy where we're in one of the worst short-term periods of the year for the market over the next week or so. Over the next 3 months, it's one of the best seasonal times of the year. So the last week of September is one of the weakest. October and the rest of the year, fourth quarter, is historically the strongest. And when you look at years where we've been down 10% or more heading into the fourth quarter, the average returns are in those years are about double the historical average. So from that respect, that's something somewhat positive on a really bad day here. But the one difference, as the prior guests have been talking about, is this period is sort of unique in the fact that the Fed is pretty much openly rooting for, if not a weaker stock market, a weaker economy.
That's for sure, yeah. And, looking like the market is at least assuming that the soft landing is far less likely than it was a few months ago. Now, the extreme moves that we're seeing in bond yields and, to a degree, currencies has everybody on alert for when they're going to just pause and reset a little bit lower, right? They've just kind of become very stretched. What does it look like to you in terms of, the short-term yield picture and other factors that really on a macro basis have been keeping the pressure on stocks?
Yeah, so we're starting to reach some extreme levels in the market here. But in this environment, these kind of periods in the short term, they go on until they go on. So, it's really, to say that we're going to reach this level, that's when things turn better. You're playing with fire doing that. From a longer term perspective, investors should just, stick to their plans and not get too out of bounds with what's going on in day-to-day movements. But a lot of what's happened this week is a reflection of Fed and Fed policy and, seemingly a lack of credibility on the part of Fed members. But this week, it hasn't just been the Fed. It's not every week that you see a nuclear superpower threaten nuclear war. And maybe it's not. It's probably very unlikely, but that's going to cause concern on the part of people. So if we do see going ahead in the weeks ahead that some of those tensions start to ease, that's going to certainly cause some relief on the market. And for everyone talking about how off sides the Fed is, at the same time, they're saying that rates do need to be higher. I think it's a reflection of what the Fed is saying and trying to talk a real tough game. They should have just been, moving rates to where they think they should be rather than just keep, the slow bleed to higher rates here. Just get it over with. Just like in March, they were too late to stop buying treasuries. Now they're too late to hike rates. They're just, easing us, trying to ease us into the game. But just get it over with.
Yeah. Well, 375 basis point moves in a row, maybe they don't consider that to be so piecemeal and slow. But I get your point, because they do clearly have a destination in mind, and we might as well just hurry to get there, I suppose, Paul.
Yeah.
Listen, appreciate it. Thanks a lot on a big market day. Good to have you.
Thanks. You too, Mike.